When we hear the words stock market, it usually feels complicated. The charts, the news, the experts shouting numbers across television studios, the sense that something serious is always happening just out of reach. I used to think the same way. For years, I assumed the stock market was something you need a finance degree to understand, and that the people on TV know something I didn't. Once I actually looked at how it works underneath the noise, the whole thing got a lot simpler, and the noise stopped feeling so important. Think about it this way. Every time we buy a coffee at Starbucks, watch Netflix, or scroll through Instagram, we are helping those businesses make money. The stock market is simply the place where instead of just being customers, we get to own a piece of those business and grow our money alongside them as they grow. In this episode, we are going to break down what the stock market really is, why prices move the way they do, and why over the long run the system has tended to move in one direction, up. And by the end, the stock market should feel less like a casino and more like what it actually is, a marketplace for owning real companies. Hey, I'm João, and welcome back to Investing Basics for Beginners. In the first episode, we covered why investing matters in the first place, how inflation quietly reduces our buying power, and how investing helps our money keep up with and even outpace that drift. So, today we are taking the natural next step, understanding the engine where most of that growth actually happens, which is the stock market. This is the part of investing with the most confusing terminology, and it's also the part where that language scares people away from something that's generally accessible. The truth is that the stock market hasn't fundamentally changed in over 100 years. The technology around it has, but the basic mechanics are still the same as they were a century ago. Once we understand those mechanics, the daily noise stops feeling so urgent. Let's start with a simple way to picture it. Imagine the stock market as a giant supermarket, except instead of shelves filled with apples, bread and milk, the shelves are filled with companies. Apple is in one shelf, Tesla is on another, Coca-Cola, Microsoft, Nike, every major business we interact with in daily life, they all have a spot on the shelves of this market. When we buy a stock, what we are actually doing is taking one of those companies off the shelf and bringing a small piece of it home with us. That's all a stock really is, a tiny slice of ownership in a real business. If we buy one share of Apple, we don't get to walk into a store and take a free iPhone, but we do legitimately own a microscopic fraction of the company that makes them. And if Apple grows, sells more, expands into new markets, become more valuable, the value of our slice grows along with it. This is the part that genuinely changes how we think about investing. We are not betting on a number going up or down on a screen. We are not gambling on a chart. We are buying ownership in companies that produce real things, employ real people, and generate real profits. The number on the screen is just a reflection of what other people are willing to pay right now for the same slice of ownership we already hold. So, if a stock represents a piece of a real company, why do prices move around so much from day to day? The simple answer is supply and demand, but underneath that simple answer there is a more interesting story. At any moment there are people who want to buy a particular stock and people who want to sell it. If there are more buyers than sellers, the price gets pushed up because buyers are willing to pay a little more to get their hands on available shares. If there are more sellers than buyers, the price drifts down because sellers have to accept a little less to find someone willing to take the shares off their hands. That's the mechanical part. Supply and demand, just like anything else. But what makes the stock market interesting is why people are buying or selling at any given moment. And the honest answer is that it's a mix of two very different forces. Sometimes prices move because of real substantive news. A company releases a strong product, reports better than expected earnings, signs a major contract, or runs into a real problem like lawsuit or leadership change. That kind of movement reflects something genuine about the value of the underlying business. But often, prices move for reasons that have nothing to do with the actual business at all. Fear, excitement, hype, rumors, headlines that turn out to be misleading, broader economic worries that don't really change what the company does. All of this push price around in the short term. This is why a perfectly healthy company can have a bad week in the market for no real reason, and why a struggling company can have a great week just because of a viral tweet. I'll be honest, in my early days I used to react to every red day on my screen like something had changed. It hadn't. The companies were the same, the fundamentals were the same. The only thing that changed was the mood of the people trading that stock. Once I learned to separate the noise from the actual signal, investing got less stressful. The takeaway is this: short-term price movement is a mix of substance and emotion. Often more emotion than we had expected, and over weeks or months it can look chaotic, but over years and decades the noise tends to fade, and what's left is the underlying reality. Strong companies grow, and the prices of their stock grow with them. Now, when people in the news say things like the market was up today or the market crashed, they are usually not talking about one company, they are talking about an index. And understanding what an index is changes how we think about the whole thing. An index is a curated group of companies that's used as a kind of thermometer for a section of the economy. The most famous one is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. Others include the Dow Jones Industrial Average, which tracks 30 of the biggest US companies, and the Nasdaq Composite, which leans heavily toward tech. There are also broader ones like the Total Stock Market Index, which tracks essentially every publicly traded US company in one basket. They all do the same basic thing: give us a single number that summarizes how a whole group of companies is performing. This is useful because no single company tells the full story of the economy. Apple having a bad quarter doesn't mean the whole economy is in trouble. But if 500 of the biggest companies in America are all collectively having a bad quarter, that probably means something real is going on. Indexes are how we read the broader signal underneath all the individual companies' noise. And here is the part that's genuinely remarkable. Despite wars, recessions, financial crises, pandemics, political turmoil, and decades of bad news cycles, the major stock market indexes have all trended upward over the long run. The S&P 500, for example, has averaged roughly 7% per year after inflation across more than a century, including all the worst periods you can think of. There have been individual years that were terrible and stretches of several years that felt brutal at the time, but the trajectory across decades has consistently bent upward. The reason isn't magic. It's that the underlying companies keep producing more goods and services, finding more customers, becoming more efficient, and generating more profit over time. The market is just the sum of those companies, and as long as the broader economy keeps growing, the market that represents it tends to grow with it. This is the part that connects everything back to us, and it's worth being explicit about. When we invest in the market, especially through a broad index, we are not betting on a single company or trying to guess which one will be the next big thing. We are participating in the collective growth of businesses, technology, and the broader economy. Think about it from a daily perspective. Every time we use a smartphone, the companies that make and supply parts of that phone are generating revenue. Every time we shop online, the platforms running it earns fees and the logistic companies behind it move packages. Every time we use a credit card, the payment networks take a tiny cut. As shareholders in a broad index, we own slivers of all of those companies at once. We are not just consumers in the economy, we are owners participating in its growth. I will admit, this is the framing that made investing finally click for me. It stopped being about predicting some chart and started being about owning small pieces of the things I already used every day. The mental shift was bigger than I expected. This is what makes investing feel less abstract. It's not gambling, it's not picking lottery numbers, it's claiming a small share of the actual economy activity happening around us every day, and letting time and growth do the rest. Let's pull this together. The stock market is, at its core, just a marketplace for owning pieces of real businesses. Nothing more mystical than that. Stock prices move based on supply and demand, which is sometimes driven by real news and sometimes driven by pure emotion, especially in the short term. Over the long run, the noise tends to fade and what remains is the underlying reality of companies growing. Indexes like the S&P 500 are how we read the broader signal across hundreds of companies at once. And historically, those indexes have trended upward over decades, even through some generally awful events. By investing in them, we get to participate in that long-run growth instead of just watching it happen. The stock market isn't a casino and isn't a place reserved for experts. It's a system that quietly rewards patience, broad ownership, and willingness to let time do the work. In the next episode, we are going to break down the three main building blocks of investing: stocks, bonds, and ETFs in plain language. We'll go through what each of them actually is, how they behave differently, and which ones tend to make the most sense when we are starting out. If this episode helped the stock market feel a little less intimidating, hit subscribe so you don't miss what's coming. And I will see you in episode 3.